Thanks everybody for being patient. My name is Mark Polatkesen. I'm from Mortgage Domain, and I'll be running the seminar tonight about property finance. We'll be speaking to specifically to property investing. So we're covering off quite a lot of topics in and around how to invest in property, about obviously how to sort of use equity and things like borrowing capacity, valuations, all that sort of thing. If you aren't an investor and you did have some general questions about finance, which I haven't covered, you do have the ability to type your comments into the chat section as well as the Q&A, which will be on the top of your screens. But yes, if anyone doesn't have any questions for the time being, I will get into the presentation right now. Perfect. Just a little bit of information about us and Mortgage Domain. So we are the finance or one of the finance partners for Pete, and we have been in finance for the last 21 years. We do specialize in new construction or construction finance. We're one of Australia's largest brokerages when it comes to our construction finance. We deal a lot with first-time buyers, investors, and typical owner-occupiers. In terms of the business, we've got about 40 or just under 40 staff in total. Our broker team are available 7 days a week. And we won some national awards such as Customer Service Brokerage of the Year, and most recently a 2024 product review for Best Home Loan Provider. I thought I'd just get stuck into a bit of a market update. So I suppose interest rates are very topical at the moment, and we do see quite a lot of clients asking, I suppose, just pretty standard question when it comes to interest rates and where they're heading. So for us, we are seeing inflation dropping pretty sharply, and it's now finally within the target range. So the last quarter's reporting had inflation sitting at about 2.8%. So usually that will sort of indicate that the rates are likely to get cut soon. We are due for one more Reserve Bank meeting this side of the year, being the 10th of December. So the RBA will meet again and obviously review inflation and make a decision as to whether or not the rates are going to stay, increase or decrease. But we are seeing quite a lot of positive signs when it comes to interest rates with a lot of lenders in the fixed rate space. So a lot of lenders are actually sharply reducing their interest rates, some as low as about 5.4%. And usually the banks will take a long-term view as to where they think the rates are going to be heading. So if the fixed rates are a little bit lower than what the variable rates are, chances are the variable rates are probably going to catch up at some point in time or even be lower than what they are in the fixed rate space. In terms of the bigger banks, Westpac and CBA had initially forecasted rates to be cut in the last quarter of 2024. But there was recently an update to say that they're probably going to hold off until the first 1 or 2 months of 2025. So given that the first RBA meeting for 2025 will be in Feb, that's probably when they're likely to see a rate cut. But no guarantees. We'll see what the meeting's going to sort of hold in February. In terms of other surrounding countries, positivity in New Zealand, we've seen 2 rate cuts in the last 2 months. They've actually had a 0.75% discount over the last couple of months, and their inflation sitting at about 2.2%. So yeah, hopefully Australia will sort of follow suit and we'll start to see some rate cuts. What we did see at the start of this financial year, the government basically had reduced the tax rates for a lot of people. So if your income was below the $190,000 threshold, you would have got a higher sort of net income. And what that actually resulted in higher borrowing capacity. So we did some modeling on a couple that were each earning $90,000 or $180,000 as a household. And they were instantly improved with their borrowing capacity by about $50,000. It doesn't sound like a lot of money, but does make a bit of a difference when it comes to your ability to borrow. A lot of banks are kind of forecasting that the rates will bottom out at about 2.85 to 3.1%. What that means for you as a borrower is probably going to give you about $90,000 on average better borrowing capacity. So yeah, really positive signs there with what's going to be happening in next year. While we're on the topic of borrowing capacity, I just wanted to show you a bit of a slide. So once again, we did some modeling on a couple. We're each earning $90,000 or $180,000 together as a household. We've made some assumptions that they don't have any children or any other debts. But I just wanted to indicate to you the massive discrepancies between one bank's borrowing capacity and the next. So usually when we're talking to a customer and they don't have enough borrowing capacity with the bank that they bank with, or which lender they've got an approval with, if they need to borrow more money, it could be as simple as switching banks to get them a higher loan amount, right? You also want to make sure that obviously the lender that you're looking at is going to sort of suit your long-term goals and objectives. Every bank's got a different way of doing things. They've got different policies, and the rates are going to fluctuate from between one bank and the next. So if we're talking to investors tonight, we want to obviously talk about how do we sort of unlock equity in your current home. So I just wanted to give you a bit of an overview as to how equity works, right? So we're making some assumptions again. So let's just assume you've got a property that's worth $1 million, right? You can borrow as high as 90%, but with this example, we're wanting to avoid lenders' mortgage insurance. So we kept that loan at 80%. So on $1 million, an 80% loan would mean a maximum loan of about $800,000. What you then need to do is you need to take away your current lending. So with this example, we've assumed that this borrower had a $500,000 mortgage or $500,000. So then what are we left with in terms of available equity, right? So with this example, you're left with about $300,000 in equity to use. You don't necessarily need to use all that to secure another property. What we tend to do is with this example, we might maybe use 20% of that purchase price for the purchaser. So if you're buying a property for, let's say, $700,000, if you wanted to avoid mortgage insurance on that investment purchase, you might take $140,000 out of that available equity, plus maybe any associated costs such as stamp duty, transfer of land, conveyancing fees, and all the rest. So you may only need to use out of that 300,000, 150 maybe to 160. So you still will have enough available equity even after a $700,000 purchase with this example, right? You do also want to make sure you have the borrowing capacity to do that as well. We wanted to talk about different sort of loan structures. So quite commonly we speak to clients and the typical structure that they'll have is a cross-securitized loan. What that means is your investment purchase is usually 100% borrowed, or you've got 100% loan, and that property is then secured against your principal place of residence, being the house that you're currently living in. There are pros and cons to, I suppose, that type of structure. The pros would be that you'd only maybe need to do one application, which is secured against obviously your current home. But the other way to do it would be a sole security loan. So in the previous slide, we talk about obviously how to use equity. When you're doing a sole secured loan, you might maybe take a separate loan against your principal place of residence of that 20% portion, being that amount that you want to sort of avoid mortgage insurance. And you can take that money out of your own owner-occupied property, still for the purpose of an investment purchase, right? So that's still tax deductible. You still have the tax benefits of obviously claiming the interest. And then you might do a separate loan against the investment property on its own, and that would be an 80% lend, right? The benefits of doing that is obviously one property is not tied in with what the other, and you can actually structure these loans across multiple lenders. So if, let's say, the investment purchase is going to be better suited at maybe someone like Commonwealth Bank, and then your principal place of residence might be better at Westpac, you were able to do that with a sole secured structure. Another thing obviously to take into consideration is what name or what entity do you buy that investment in? So you can definitely buy in your personal name, so that would be just in your own names. Some other things or some other structures could be a property trust. The reason why some people would buy in a property trust is one, for asset protection. So anything that's held in a trust is a little bit more secure than something that's in your own name, particularly if you're getting sued. And there's also a certain concession when it comes to capital gains when you're holding a property in a trust for a certain period of time. If you want to know more about that information or what sort of timeframes are involved to minimize things like capital gains, I probably encourage that you speak to an accountant because they'll be able to point you in the right direction. Another thing as well when it comes to investors is total ownership splits. So let's say you're buying as a couple, husband and wife, or de facto partnership. Typically, you might say, look, I want to own 50% of that property and my partner will own 50% of that property. But then you might say, look, I want to negative gear a little bit more under my own name because I'm the higher income earner. So that title structure might change from 50-50 to maybe 90% in one person's name and 10% in the other person's name. That may allow you to have better negative gearing if you're on a higher income bracket. But the cons could also be when it comes to selling the property, capital gains could also work as a disadvantage because you're on a higher income bracket. You're going to get hit with a higher capital gains tax percentage. Everyone's obviously on different income brackets, but once again, I encourage that you speak to an accountant to give you the right advice as to how to best structure these loans. So another thing to take into consideration, so everyone wants to sort of pay off the debt as quickly as possible. But with investors, it may work a little bit differently. So you may want to maximize the amount of lending that you do have against that investment property. And that's purely because the higher the loan amount, the higher you can claim when it comes to negative gearing. So there are certain tax benefits when it comes to keeping your loan as high as possible for as long as possible. Right. So with this example again, so we made some assumptions of a $700,000 mortgage at a 6.5% interest rate over a 30-year loan term. We're also assuming that this investment property is going to be returning $550 per week, or that works out to be $2,383 per calendar month, right? So if you're paying that mortgage as a principal and interest loan over a 30-year period, you are, as a principal and interest loan, you're paying $4,424 per month. But then when you take away the rent, you're out of pocket by about $2,040. If you pay interest only, that then reduces to $3,792. So you're only $1,409 per month out of pocket, right? Obviously, this is obviously just an assumption. You might be getting a higher rent, you might be paying less interest, and obviously this will sort of reduce some of the shortages here. Other considerations as well. So these obviously doesn't get factored into your monthly repayments, but potentially your in the financial year tax return, where you might get some credits, negative gearing. So for those of you that aren't aware or aren't familiar with what negative gearing is, essentially negative gearing is the difference between, I suppose, what income you're earning, which is typically your rent, versus the expenses that are associated with the property. So the expenses could be your interest repayments, your council rates, your management costs when it comes to the real estate agent. But then you've also got depreciation as well with a brand new property or properties up to 7 years old. So these are certain add backs which could actually improve the refunds that you get at the end of the financial year. But once again, the disadvantages of paying interest only, you can't go interest only for a 30-year loan term. So just keep that in mind. The banks will only ever issue a 30-year loan term as a maximum in most cases. And if you're applying for a 5-year interest only period, they just want to make sure that you're in a position to pay back that loan in the balance of that 30-year term. So with a 5-year interest only term, that means you need to pay back that loan in 25 years. It is not uncommon for a lot of investors to actually keep recycling that debt. So let's say in 5 years' time, you refinance that loan and go for another 30-year term and go interest only again for another 5 years. A lot of investors may want to sort of pay interest only on their investment loans until they've actually paid off their own mortgage, because there's no tax benefit for you to have a higher mortgage against the place that you're living in. You want to knock that debt off as quickly as possible in most cases. But that was just a quick overview as to how property investing works when it comes to financing. I just maybe just open it up to a couple questions for anyone that had any, or any information that I hadn't quite covered tonight. So once again, if you want to leave any questions in the chat or Q&A section, I might give you everybody a couple of minutes just to sort of leave any questions that you might have. So just I'm just reading that. I just had a question here about borrowing capacity. So just relating to having sort of additional debt. So um, yes, credit cards are definitely going to have an impact on your borrowing capacity. As a rule of thumb, or just as a quick example, if you have a $10,000 credit card, even if you don't use that credit card at all, even if you don't have any balance owing, that is still going to impact your ability to borrow. So as a $10,000 credit card, it's probably going to reduce your borrowing capacity by about $50,000 on average. Next question is just about rental income. So will the banks take all the rental income into consideration when it comes to serviceability? Usually not. So what the banks do is they do take a bit of a conservative approach as to how much rental income they'll take. So if you're if you're receiving a $500 per week rental amount, usually the banks will only take about 80% of that amount. So on $500 per week in terms of rent, they may only work out to be $400 in terms of serviceability. So they don't always take 100%. Just one of the next questions was, are interest only repayments or interest only rates higher than principal and interest? Yes, usually they are. So just to explain how interest rates work, usually the banks will give you a cheaper rate on your principal place of residence or the house that you do live in. If you're an investor, sometimes that rate can be a little bit higher. It's not a much, but might be maybe 0.1 to 0.3% more expensive. If you're paying principal and interest, but then if you're paying interest only, that might increase once again by 0.1 to 0.2%. So the variance between principal and interest on your owner occupied versus an investment interest only might be about 0.4% as an average. Might give everybody a couple more minutes if they had any other questions. This one's just about valuation. So yeah, fair question. Valuations can actually fluctuate massively between one bank and another. So we recently had an example with one customer on the exact same property. They gave us an estimate of what they thought their property was worth, which was about 900,000. We actually conducted 3 valuations on that property. So the first valuation came in at 865,000. The next valuation came in at 955, and the final one was 1,050,000. So it's about $180,000 fluctuation between the lowest valuation to the highest. So usually what we like to do is we like to order upfront valuations because obviously that's, usually a key driver as to which lender we're going to be selecting. Sometimes it's not, it's probably more important than the rate that you're paying, because if we can unlock more equity, you might be able to buy another property or maybe even avoid mortgage insurance, which is much more compelling than what your interest rate might be. So I definitely encourage ordering multiple valuations on your owner-occupied property, and just checking, just to see how much of a discrepancy might be between one bank and another. Okay. Any other questions? Okay. Don't seem to have any other questions. I might just give everyone another 1 or 2 minutes, just in case they had any questions. Okay. We don't seem to be getting any other questions, so we might just stick around for another minute. Well, just wanted to thank everybody for their time tonight. I really appreciate it. Hopefully you found the information helpful and useful. I will be sharing the presentation with Pete to distribute tomorrow for everybody's own records. But yeah, once again, I really appreciate your time. Yeah, feel free to sort of drop me an email. My contact details will be on the presentation as well for anyone that had any questions. Thank you once again.